Okay, so now we have to talk about demand zones and how are we going to draw these demand zones. So the demand zones are going to be universal, but each demand may look different depending on the type of candlestick formation we receive, right? So for every demand zone, we're going to look to the left of the chart. The reason why we look to the left of the chart is because we're looking for a previous zone where those unfilled orders are. And the only confirmation we receive to get this zone is we look for a basing candle followed by a strong move to the upside. So we look to the left of the chart for that because currently we're not going to see that. This basing candle right here where my cursor is where those institutions begin to leverage in their position. We only see that and we only get confirmation after the fact we get a strong rally to the upside for a demand zone, right? Because we got this strong rally to the upside, the supply to demand equation is imbalanced and there's a greater demand than supply. If we didn't get this strong move to the upside before or after a basing candle, this wouldn't be a valid demand zone. The only reason this makes it a valid demand zone is because we have a basing candle followed by a strong and violent move to the upside. So where do we begin drawing these zones? Well, we have an upper line and we have a lower line. For a demand zone, the zone starts from the top of the body. So this is important. It's always the top of the body of the basing candle to the bottom of the wick if you do have any wick, right? I'm going to show you guys different patterns and different demand zones, but the zone, the top line or the top of the zone, the top of the rectangle, however you draw it on your chart, starts from the top of the body of the basing candle right here to the bottom of the wick of that candle or a candle next to it if it's close, right? It's very subjective. It could be different for every zone, but just to know that we have a strong move after a basing candle is what qualifies this to be a demand zone. So once we get this demand zone, I wait for price to re-enter the zone and I only trade after and if the stock returns to the originating demand zone. This is where I'll get my high probability, low risk, high reward trade. I could get an entry here in this demand zone, wait for price to reject or bounce off the level, and then buy or long my position accordingly and put my stop loss on the bottom of the demand zone or the bottom of the wick if you do see any wick. So here's a realistic chart of Amazon and we have a demand zone that formed, right? So we have a small body basing candle, right? The top wick really doesn't matter because the demand is from the top of the body to the bottom of the wick, right? So we look to the left of the chart, we find this demand zone. We have this basing candle. We look for small bodies, small basing candles, followed by a strong move to the upside, right? You guys can see this strong, violent move to the upside. So this is going to be your demand zone. And I will only trade if the stock, if the price returns to this zone, and this is where I'll get a low risk, high reward setup, right? So as you guys can see, it's the same picture. Here's where the demand zone where it originated. And look what happens the next day. We opened up, right? The stock was coming down, as you guys can see by this lower wick right here. The stock was coming down, looked like it might have been breaking down to the downside. Retail traders are selling here, right? But they're selling in a demand zone. If you know there's a demand zone, you should tell yourself, I'm not selling here, I'm only buying. So look what happens. The stock returns to this demand zone. You have a wick here. The orders get quickly absorbed. The buyers of those unfilled orders and the institutions step in, and the supply couldn't exceed demand. Demand overrode the supply, and look what happens when we touch the demand from this lower wick. Price shot up, and that would have been an excellent trade. So demand zones can be from any time frame you look at. It doesn't matter if you're looking at a smaller time frame to a higher time frame. You can find these imbalances on any time frame. All you need to validate and to confirm it's a solid demand or supply zone is you need a consolidation or a basing candle followed by a strong and violent move to the upside. So the way I do it is I always start with a higher time frame and I always move down to smaller ones. So I'll start out with a monthly chart or even a weekly chart, right? Then I'll move my way down. After the weekly, I'll go to a daily chart. Then if I don't see a supply or demand on a daily, I'll look for a 4-hour chart. Then a 2-hour, 1 hour, 30-minute, 15-minute, and 5-minute. So those are all the time frames I use, but like I said, you can find the supply or demand zone from any time frame. I work my way down, and visually on a chart, the more you guys become aware of these zones, you guys will see consolidation and basing stages, and then you'll just search for the time frame accordingly. And whatever you find a basing candle is going to be a valid zone, right? And what's important too is that it doesn't matter how long in the past the zones have been sitting there, right? So I'm going to show you guys a chart in a bit, and a zone formed, let's say 3 months ago, and currently yesterday, the stock hit that zone and the price jumped up accordingly, right? So it doesn't matter how long in the past the zone has been sitting there. All that matters is if there's unfilled orders, it could be 5 years ago, right? There still could possibly be some orders there that will cause the supply and demand equation to become skewed. So they'll keep their orders there. They'll keep their limit orders. Remember, their passive orders there until price reaches that level again. And what the key is you have to identify fresh zones. Those are going to be higher probability trades. And what I mean by fresh zones is zones that the stock hasn't reached after it created an imbalance, right? So we have all those orders at this level. A fresh zone is a zone where the imbalance originated and the stock hasn't reached that zone. So those unfilled orders will still be there, and those unfilled orders will still be at that quantity that it was when the stock first moved away from that zone. The more times the stock enters the zone, the more orders it will fill, and the greater of the chance the zone will not work. Those are called used up zones. So the key is to find these fresh zones, because let's say you'll have 100,000 unfilled orders at that zone, right? When the stock comes and reaches that zone again, those unfilled orders will absorb current market orders. And if the imbalance still is greater, if the demand is greater than supply or supply is greater than demand, the stock will follow to that demand zone or follow to that supply zone, whatever you're looking at, right? But the more the times the stock enters the zone, the more orders it's going to absorb, and the greater of the chance the zone will break and it will not work. Those are used up zones, right? So here's an example of a zone that formed about 30 days ago. So we have a basing candle down here, a small bodied candle followed by a strong violent rally up. This is our demand zone, right? We draw it from the top of the body of the basing candle to the bottom of the wick of that basing candle. We draw the zone and we wait until price reaches that zone again. Look what happened when it reaches that zone. We get a strong large lower wick indicating buyers, those unfilled orders, stepped in. The sellers, the supply, couldn't exceed the demand here. That's why we didn't get a break of the zone. Demand exceeded supply, and look what happens once we tag this demand zone. Price rallied straight up afterwards, right? So this is an example of zones that formed either a couple of days ago, a couple weeks ago, even a couple of months ago, right? Just you want to make sure it's a quality, fresh zone. That's when you'll have those high probability trades. Here's another good example. Here's two demand zones on two different equations, right? So we have a small body basing candle followed by a strong violent move up, right? So this qualifies as a demand zone. Now we wait for price to re-enter this demand zone, and look what happens. We tag it once, we tag it twice, and price comes up after that, right? Then, actually, price never even came below this demand zone. So it'd still be a valid trade because you would have never got stopped out. The price never came below the lower wicks. So you would still be holding on to this trade. And then look, on the same chart, this is a monthly chart, by the way, so every candle represents a month. On the same chart, we have another demand zone that formed. Right here, we have a basing candle followed by a strong rally to the upside. We draw from the top of the body to the bottom of the wick, and look what happens when price reaches it. We get a nice quality bounce from there, right? So here's an example of a used up zone, because I know some of you guys are going to be confused with used up and versus fresh zones. So we have a used up zone. Here's a demand zone. We have a move to the downside. We have a strong move to the upside. So we look for this basing candle here. We find a nice basing candle, top of the wick top of the body to the bottom of the wick, qualifies as demand zone, right? Price then comes into this demand zone. We get a solid bounce, right? This first green arrow here is the first touch of the demand zone. This candle right here where my cursor isn't in the demand zone because this wouldn't have been qualified as a demand zone if we didn't get this candle. So this is in the demand zone, but it isn't unfilled orders, right? So the first test of this demand zone is where this candle is, where my first green arrow is, because we get the test of those unfilled orders. And the demand still exceeded supply here, so we get a nice lower wick here, and we get a nice move to the upside. So it worked the first time, it was clean, and it was a fresh zone because there was no other times that price was in this box. So the second time we come into this box is the second arrow. It's the second time it worked. As you guys can see, we get a nice lower wick, and we had a nice move to the upside. Even though it's a red candle, price still rejected this box. Now, this is a daily chart on the S&P, by the way, too. So the second time this zone also worked, but it was a lower probability trade because we tested this zone for the second time, meaning there's going to be less unfilled orders at this area, and the easier it is for price to break below the box. And as you guys can see, the third time we were in this box, the third test of it, the demand didn't exceed supply, and we tested and we dumped straight down because all those unfilled orders, we don't have a lot of them anymore because the price has been testing it for a while, right? The more times you test the zone, the longer you're in the zone, the more times those unfilled orders are going to get filled, and you won't have enough unfilled orders that could possibly skew the imbalance again. So now we have a nice chart pattern that I look for demand zones. It's called a rally base rally, RBR, if you ever see me talk about that, right? So what an RBR is, it's very simple. We have a rally to the upside, then we base out, and then we have another rally to the upside. This wouldn't be qualified as a demand zone if we didn't get the second rally. The only reason why we got the second rally is because we have a demand that's exceeded supply. So if it wasn't for the second rally, this wouldn't be a quality demand zone. So we get a rally up, we base out, then rally again. It's a bullish momentum pattern. Price pushes up and creates a short balance period. So the balance period we're looking at is the base. And what they do in this basing period is where these institutions start leveraging in their position here. And then we get our second rally up after they attract the price to come up. So this is where they leverage their position. This is where unfilled orders are going to be in the past. Creates a demand zone here, right? So there's two ways you could trade this. You could trade it after we get a nice rally up. We get this basing period, right? You can trade it at the break of this basing period with a stop loss below the base, right? Below the bottom base. So entry above the base, stop loss below the base. Or you can wait for price to possibly re-enter, right? We come down, re-enter the zone, you get an entry somewhere here, and you put your stop loss down here. And because it's a demand zone, we could bounce to the upside, right? So those are two ways we can play it. I personally wait for price to confirm and come back into the demand area in the future, so we fill those unfilled orders. So here's a perfect example of a rally-based rally, RBR. So we have a rally candle here. We have a basing candle here. You guys can see it's a red candle. Now, it doesn't have to be a red candle. It could be any candle. But the fact that we have a small body basing candle is what makes it base, right? So rally, base, followed by another rally. This is our demand zone. We draw from the top of the body to the bottom of the wick. And look what happens the next time price enters this demand zone. It's the following Tuesday. So this is a week period, right? Like I said, it could happen on any time frame, and it could happen at any time in the past. You just want to find quality, fresh zones with those unfilled orders. So price enters this demand zone, and look what happens after the fact, right? It's very simple. It's a very simple pattern. And you guys, if you guys just understand the concept of it and the reasoning behind it, you guys can really learn this and master it very fast. Here's another RBR, right? Now, you don't need just one basing candle in the middle. You have a rally here. So you have a rally, and you have a base. You have two basing candles followed by another rally up. So this is our demand zone, our basing stage, right? We follow this all the way to the right. Look what happens when we tag this demand zone. Price shoots right back up, right? So you always want to look to the left of the chart when you're plotting out these zones, because you want to find zones that happened in the past. You want to find zones that cause such a demand imbalance. We have a demand that exceeds supply, and we only get confirmation after we get a rally to the upside, right? Here's another one. This is a daily chart of the S&P as well. We have a basing candle followed by a violent and strong move to the upside. We draw this demand zone. Look what happens when price enters this demand. We get a solid bounce from there, right?